oil sector, the publicly traded oil sector, I would look at it more as a short than a long, because there is no quick answer for how they'll solve their problems. All their hedges are rolling out now, and their borrowing bases are being reset. So the real trouble for them is only just starting. Even if oil bumps up to 50 or 55, they still have problems.
I would just mention on the back of what Peter mentioned, that one of our contrarian calls is that we are actually, we like global integrated oils very much. We also like some drillers and refiners and think that there may be some value in MLPs if we do see some stabilization in oil prices, and you can carry a nice yield along the way. So we actually like global integrateds and very select refiners.
In addition to it, it's interesting to see what the Saudis will do, right? We met in Saudi Arabia with the oil ministry, last January. They seemed surprised at how far the oil price had come down. It seemed like it had come down much further. There was also, at the time, new king was coming in, so there was a little bit of a melee in terms of what that meant. But some things to keep in mind in Saudi Arabia. One, in the UAE and the rest of the GCC, we're seeing them do something that they did not do historically. They're very quickly adjusting to a lower oil price. The UAE has rolled back gasoline subsidies, which they had. In Saudi Arabia, that's being discussed. The region is discussing implementing an actual corporate tax, which never before been considered, or at the very least implemented. In fact, in Kuwait, it's written in the constitution that every Kuwaiti has the right to a job. And if you go get a job with a private company, they will actually pay you money to go get a job with a private company, so the government doesn't have to hire you. And these are the type of programs that are being discussed and questioned that we never saw before. The other thing with Saudi Arabia is we talk about how well positioned some countries are versus others. Saudi Arabia has a debt to GDP, a government debt to GDP that's about 3, 4, 5%. They have a lot of room, and they have banks that are flush with liquidity. They have a lot of room to issue debt and paper over this, depending on what their final goal is. And then lastly, they do have a new king. So we're going to see, maybe with this OPEC meeting, but they have a budget that's coming, we will see what his intentions truly are, and and how divided the government may or may not be in their response a year later to the lower oil price environment.
Thank you. We just want to ask you a little bit more. We were talking earlier about these emerging markets, frontier markets, and I had asked you about how you get comfortable with the figures that you get from some of these markets. And obviously, being an accountant, that's the first thing I focus in on is how do you get comfortable with the numbers, right? But beyond that, you're investing in these emerging markets and these frontier markets. There's obviously some political risk there as well. So how are you getting comfortable, and spotting opportunities and knowing when to stay away from certain investments, given, the political risks of a particular country?
Sure. One of the benefits that we have relative to private investments is we have the ability to move relatively quickly. We're benchmark agnostic, so we can be wherever we choose to be. Now, in terms of getting comfortable with the numbers, one of the benefits of looking at many companies in emerging and frontier markets is they're pure plays. You wake up at the beginning of the year, they're a cement company. At the end of the year, they're still a cement company. They don't have wild, special purpose vehicles named after Star Wars figures. They literally just are, so they are a cement company, a bank. Banks have, for the most part, have loan to deposits less to 100, so that means they're not out actively getting wholesale financing necessarily. They may do it just to, to manage their funding base. So we have the ability to look at experiences to other companies that we've looked at. We know what a cement company's balance sheet looks like. We know what their income statement looks like. We know the same thing for a bank, for a real estate companies tend to be a little tricky, but we know what that looks like. And so that gives you a certain amount of comfort. Conglomerates are something we tend to want to stay away from, simply because those tend to be a little bit more gray. And then in terms of the political risk, look, it is in our DNA to travel, and travel again. And any of us now who've traveled internationally and kind of done the due diligence in a country, I like to say you only have to ask a handful of people a handful of questions, and exactly who to do business and who not to do business. And reputations live in a country. And that's the importance of going and kicking the tires. And when we start doing the work, we divide the world into politics, macro, and micro. And politics being extraordinarily important because essentially you invest in Argentina Inc. before you invest in a company in Argentina, is the way we think about it. And it doesn't matter how good a company looks, if the macro looks very, very fragile, or we have to start questioning, well, at what point do we participate in this investment? Do we wait for a deval? It's something, for example, that we've been doing. Argentina was one that we got in early because we saw a political shift. In Kazakhstan, in Egypt, we were waiting for devals. In Egypt, we're waiting for devals. So it really goes hand in hand. In terms of the macro data, look, all countries have their biases. You can go to the U.S. I don't quite believe all the macro numbers that come out of the U.S., quite frankly. But there's a bias to the numbers, and it's really the shifts and the changes and the directions. And in difference to going to Japan or to the U.S. and emerging markets, you have the ability to go to a country and meet the central bank president. You have, I did one trip in Brazil about 10 years ago where I met the head of the Senate, the head of Congress, the chief of staff of the president, and the central bank president, all in one day. And you don't get that kind of access in developed markets. You just, the amount of money you have to invest just won't, is not something that most people have. So there's ways around that, and there's ways of getting comfortable.
Well, I think that we want to reserve a few minutes here for questions. So I want to go ahead and open the floor up for questions. So please.
Question for Louis. You mentioned at the beginning your crick clock. Could you elaborate on that and what countries you think may have reset their clocks?
So the crick clock, you can look it up. I think it's Alan Feldman, Morgan Stanley. If you type Alan Feldman, Morgan Stanley, crick clocks and cobwebs, or cricks and cobwebs, you'll find it on the internet. Essentially, what it does is just look to see where a country is between crisis, response or reform, improvement, and complacency. And for instance, take Brazil for example. It's a great example where coming out of Cardozo back in 2002 or so, I think it was 2002 was the election, 2003. They were improving. They had reformed those improvements, and then essentially, Lula got to ride this improvement and kind of stepped into complacency. And Dilma has basically sat through a long period of complacency. Macro headwinds went and hurt her. Argentina is one that we're quite positive on. We think they're on the cusp of the R. They've been in what's equivalent to us, a crisis, the first C, for quite a long time. And so we think they're on the verge of reform. And so you look around the world, China is in reform. India also reform/improvement. I'm trying to think of some of the big ones. Russia. My guess is as good as yours. I think it's probably somewhere between crisis and response. Everybody hates it. We think there's some opportunities there. But Mexico definitely in reform phase. So it's just one way we look at it. And then we also form what's essentially a heat map where we look at the expected growth of a country, and we measure using different variables how at risk that is. And it's just bringing it all together just to find where the best opportunities might be. Like Shannon said, you're living in a world where volatility is increasing, and we think that dispersion of returns and opportunities is what's going to be important.
Louis, another question. What countries do you consider frontier? And secondly, how do you balance the political risk and the rule of law and property rights versus the opportunity in a frontier country?
We essentially just look at the Morgan Stanley MSCI indices. Emerging market, we consider whatever's an emerging market is basically what's in the benchmark. And then a frontier market is literally every other country that's not a developed market. So everything from Saudi Arabia to Rwanda to Pakistan, you name it, that doesn't fit in the standard emerging market index. And then, how we balance this, it really depends on what the investment is. If we're dealing with a cement company, we don't really have to worry about certain regulatory concerns, or we don't have to worry about certain intellectual property rights. We have to be worried about property rights. We have to be worried about rule of law. And it's kind of interesting, when you cover emerging markets and frontier markets for so long, your sense of volatility and risk is very different than if I had been looking at Walmart my whole life. And so, look, it's really about how we get comfortable with that. It's about traveling, meeting the politicians, meeting the regulatory bodies, and just getting a sense of which direction they're headed in. That they're going the right way around the clock for every given phase that they're in. And that's probably the most important part. If you looked at Argentina right now, you'd be concerned on macro numbers, you'd be concerned on governance, Turkey the same way. But it's really the direction that they're moving that leads us to invest there. And so we're more heavily weighted in Argentina than Turkey, for example.
I just want to add, I lived in Moscow for 10 years, so I've got a little experience with rule of law. One thing is, part of what Louis can do and the value he would bring from his visits to the countries is learning what to avoid. So if you look at what drives returns for emerging market investing, picking the country, so it's the macro, drives your return. And then when you go there to understand where and how to invest, it's really about who to avoid. And if you can figure out who to avoid and what situations to avoid, that's pretty much more than half the battle, in my experience.
I have a question, I suppose, for Peter and also Louis and Michael. Okay, that one of among the key pillars of the thesis that there'll be a rebound in the price of oil has been the limited supply, additional supply available, say, from Saudi or from Russia. And then the natural decline rates and obviously the huge decreases in investing. Well, recently, though, I've been hearing the application of hydraulic and other U.S. technologies to the oil fields in Saudi and Russia to the extent that we may have significantly underestimated the supply that might be available. Do you share those concerns?
No. So they've been fracking in Siberia for a decade. To do it successfully, there are very few places in the world that are set up to do it successfully. It's not just a simple technology. You can bring it and transport it anywhere you want to go. There was a discussion about Poland, and as huge reserve numbers came out that Poland was a major source of fracking success. And they went and fracked a well and found out that the reserve number should be zero. It wasn't going to produce anything. China's having the same trouble. China's all over the U.S. taking technology, investing in companies, and putting money into JVs to get the technology, but they haven't been able to figure out how to apply it. The Saudis, their lifting costs are going up dramatically, and it's been going on for a decade. So the big secret with the Saudis is their cost of production is going up. Their oil fields are getting older and more depleted, and they've got the best guys from Austin going over there to help them with their enhanced recovery techniques. So they're trying everything they can, but the idea that there's going to be some big breakthrough, there'll be incremental gains, certainly, but as you point out, it is a depleting asset, always is. So part of it is new discoveries, sure, we always look for those, but when you have a naturally depleting asset, it means you have to put new capital constantly into production and into the asset. And that's what will drive oil prices higher, is how much capital is going to find its way into the mix. And so, yeah, I don't think that that's a huge risk to the story.
We'll take one more question, and I think our panelists will stick around for a little while to enjoy the networking following. So, one last question in the back. Yes, sir.
You clearly believe in peak oil theory, then, I assume, correct?
No, I don't believe in it at all.
You don't believe in the peak oil? This question goes for anybody with the new technology in shale, the changing the climate of the political climate of emissions. Do you still, you touched upon it that you think that oil will continue to go up, but with that being said, do you think there's still a possibility that oil won't go up because of emerging technologies, the change in emissions?
That would be great, right? I mean, to get rid of fossil fuels would be awesome, but the reality is that it's just not going to happen overnight. So it's how you manage that process. So along the way, we have to do what we have to do, which is we have a messy process of pulling oil out of the ground and gas out of the ground until those new technologies are developed. And I think that's a regulatory, a tax issue. It's incentives that aren't put in place. But yeah, I mean, I personally love to see fossil fuels.